And we are live. Are you looking for venture capital money? Do you expect to be looking for venture capital money? Do you have a high growth company? You're planning for a high growth company? Well, today we're going to talk about the business of venture capital, how they value businesses, what they need. Hopefully that will help you build your business plan and help you in your discussions. Welcome. Martinis with Scott, episode 23. Martinis with Scott is an in-depth conversation. We'll turn this music off here. An in-depth conversation about winning at business. Hopefully, we are helping business owners, entrepreneurs, directors, investors of businesses. And that's what the intent of this show is. Today, we're coming to you live from 20 Bay Street in Toronto, the offices of Sinclair Range. And this is my second attempt at this show. I recorded it and wrote it last week while traveling, and the production quality was horrible, so I didn't release it. We're redoing it now, and I'm going to try and update it. We're going to talk about some cannabis stuff later in the show, and I'll try and update it for today's events or this week's events rather than last week's. Let's have a drink. Martinis with Scott. I hope everybody's having a great week. Ashley, what are we drinking?
We are drinking Dylan's vodka from Niagara.
If you can't hear Ashley, it's Dylan's vodka from Niagara. I'm told we're out of the Fernie Distillery vodka, which is now my new favorite. So I will have to go. I had a conversation with the owner. Finally, yeah. I ran into her at the distillery itself because they have a beautiful cocktail bar there, and or a fun cocktail bar. Anyways, she was thrilled that we love her vodka, and you know, they're really just batch craft, really small. So it was great. It was a fun conversation. Talked about the new equipment they're putting in, and we're going to bring it to Toronto. All right. Martinis with Scott, please subscribe. We're on YouTube. Look up the Martinis with Scott channel. Hit subscribe. Same on Apple Podcasts and Spotify. All right. So as I said, this is my second attempt at this. A couple of other little notes. This is episode 23. Episode 22 we released was a recording of a seminar that I was part of and hosting, sponsored by Gowling, WLG, and HNB out of Chicago, and Sinclair Range, my firm. So the three of us sponsored a seminar in Toronto that was exclusive for bankers and turnaround people involved in the insolvency turnaround industry. It was on cross-border. It was on hot topics. It's long and it's really technical, but I think it was a success for the people that are interested in that part of the business. So we're going to try and do that more. So, for example, I've been asked to speak at a conference mid-November of the IFA Canada seminar. Not quite sure what that is, but they're factorers. Factoring is a type of banking. We've had a couple of shows with factorers, actually, so you can go back and look at some early episodes. Anyways, I was speaking on that. They want to know about financing in the cannabis business, so we're going to try to record that live as well, or record it and get it released on the Martinis with Scott channel. So we'll be doing more of that. Again, it's a little technical, but the content is there if you're interested in that sort of that part of the business. So let's jump into today's agenda. Number one, venture capital funding. If you have a early stage business and you need venture capital, or you're creating a business plan that is going to be reliant on venture capital, wouldn't it be great to understand how VCs think, how they value your business, what do they need? That's going to help you craft your business plan, create your strategy, and it's going to help you in negotiations with the VC. So that's the goal today. So, and again, we're going to talk primarily about valuation. Well, entirely about valuation and the needs of the VC. So what is value? How do you define value? And there's if you look it up on the internet or in textbooks, business books, there's a million different ways that you can look at defining value. For me, the easiest and most comprehensive is that value of any business or any asset is the future money that you can, after tax, that you can put in your pocket, discounted to today for time, discounted for time, and discounted for risk. Simple as that. So how much money, expressed in today's dollars, can I put in my pocket from this business? That's what value is, conceptually. There's a lot of math that needs to go behind that, but easy to think about it that way. So discounted for time, discounted for value. So let's talk about time. What does that really mean, discounted for time? And an easy way to think about this, if you're not trained in finance, think about it as the reverse of the inverse of compound interest. And so we all understand the magic of compound interest. If you took $100 today and you put it into a relatively risk-free investment, there are no interest rate today, so you can't put it in a savings account. But let's just say hypothetically you put it into a money market fund or some sort of low-risk mutual fund, and it's generating some amount of return. 5 years from now, your $100 is going to be worth more. Through the magic of a compound interest, is it going to be worth, what it's worth is dependent on the rate. But let's just hypothetically say it's worth $120 5 years from now instead of 100. That's what compound interest is. And I think we all understand that. Similarly, if we work the reverse of that, we all understand that if I said to you, if I said to Ashley over here, Ashley, I'll give you $100 today, or I'll give you $100 in 5 years, which one would you prefer?
Today.
You would want the money today, not only because you got things you need to buy, but because the value of $100 today is more than the value of $100 5 years from now, right? Why is that? You could take that $100 and you could put it into that risk-free investment and have it compound, and it would be 5 years from now, you'd have more than 100. You'd have whatever it works out to me. So $100 today might be worth $80 today. $100 in 5 years might be worth $80 today or $70 today. And when you understand that concept, and we've eliminated risk from this equation, this is just time. When you understand that concept, there's really fun things or crazy things that you can do in finance playing on that. So I remember, it was a bit of a sidebar story, but I remember, let's call it the early 2000s. Sorry for dating myself. On this street here, Bay Street in Toronto, Canada, there was a fund, and to my recollection, it was called Portis. And it turned out to be a scam, and the regulators got over it properly. Maybe not properly, but it was certainly a sham. And they started a fund, let's call it, I don't know when they started, 2000, 2001, but it was after the tech bubble. That's the point. The bubble burst and people's mutual funds and their investments went down. You saw all sorts of mutual fund statements that were 50% of what they used to be the year before. Like, it was just a massive crash, maybe 40% of what they were the year before. People that were relying on these investments for their retirement, pension income, all this sort of, not pension income, but a monthly income, all that sort of stuff. And it was wiped out by these crazy tech valuations bursting. And so what the Portis guys did in the face of all that is they came up with the idea that they will give you a guaranteed a principal guaranteed investment. So they said, you give us $100 today. Now their minimum unit was probably $150,000, but you give us, let's use that, $150,000 today, and in 5 years, and we're going to invest it, and you may have a great return, but at a minimum, you'll get $150,000 back 5 years from now, guaranteed, absolutely guaranteed. And there was some backup as to how that was guaranteed. So you invest and you get your money back, and maybe you make some upside. And everybody thought, and maybe the upside's good, but there's no guarantees on that, obviously. So everybody thought, wow, I just got wiped out for half of my value of my personal net worth. I'm not going to be able to retire. And here's some people in this chaos environment of this tech bubble bursting that I can make an investment. They seem like good guys. Maybe I can make a bunch of money, but at worst, I'm not going to lose money. That was really attractive at the time. Really attractive to the point where Portis raised, don't hold me to the numbers on this. This is like so long ago, 15 years ago or longer. Yeah, longer. It was so long ago. Anyways, they raised $800 million on this product, which maybe in today's world doesn't seem like a lot of money, but I'm telling you, in 2001, that was a pretty decent raise for a couple of guys that started up a new fund. And so what were they doing? What they were doing was they took, I think the math back then was about 68% of your money. So you gave them $100. Again, the minimum unit was 150 grand, but I don't even know if that's true, but that would have been a sophisticated investor at the time. They took, so $100, they took 68 and they put it into a secured investment, like a money market fund or whatever it was with interest rates in those days. And through the magic of compound interest, $68 was worth $100 5 years from now. Your principal is guaranteed. They have $100 coming 5 years from now to give you your money back. They also have $32 for free, right? They gave you they took 68 of your 100 and they put it into this fund, and now they have $32. So what did they do with that $32? Well, they didn't tell you what they did. They had a black box hedge fund model. We're going to do this, we're going to do that, but they wouldn't give you any disclosure. There was offshore entities, there was this and that. And what they did in reality was they took about $10 or $12 out of that 32 and they spent it on the distribution channel. What is distribution channel in that business? That means the people selling this product to you, right? The agents, the financial planners, the mutual fund salesmen, the stockbrokers, who's ever raising, the wholesalers, who's ever raising this money, they all need to be paid on success. Where's the money coming from? It's coming from you. It came from your $100. So they took all of that money and then it went out the door to the distribution channel, not disclosed, of course. And then the balance of that, so what are we down to? We're down to about $20 out of your 100. The balance of that was used for investment. Nobody knows what that investment was when the shit hit the fan, so to speak. It turns out that there were some diamonds, as I recall, that went to Israel, and there was a bunch of stuff in offshore, this and that accounts. So, as I said, the regulators legitimately shut this thing down, and there was a big receivership. But in the end, what's interesting is every investor got, as I recall, 97% of their money back. And why didn't they get 100%? Because 3% or so went to the receiver insolvency process, trying to track down the other 20, which was gone. Okay, but the compound interest magic worked. It worked. So they all got their money back, more or less. And as I said, this entire premise of this fund and this $800 million they raised, again, don't hold me to the numbers, it was so long ago, but the entire premise was as simple as compound interest and discounting. And so there's the sort of things you can do in finance. And that's an interesting story. Just as a sidebar, at the time I owned some mutual fund companies, and we had investors in this product. So I sat on the board of concerned quote unquote investors who were dealing with the regulators and the receiver. I was not a good fit for that board because I actually made a rule in our finance mutual fund company that we were not allowed to sell this product once I learned about it, because I could just see this coming from a mile away. So I think we ended up with $500,000 or $1 million of clients' money in there that snuck in before I put the ban on the product. And so we were looking to recover that. But anyways, I was not a good fit because I think the regulators had a lot to do. They didn't have their hands clean on this. There's no way that this company should have been allowed to raise that money. Anyways, different issue. So that's what we're talking about. Go back to the venture capital side here. So we were talking about discounting for time and compound interest, which we've done. Now let's jump into risk. What is the risk issue? Well, let's consider risk from a venture capitalist's perspective. Venture capital is a portfolio investment game. So what does that mean? It means that if you're betting on high risk startup or early stage companies, you don't make one deal and hope it works out. What you do is you make a whole bunch of deals and you recognize that only some of them are going to work out. And the ones that do work out, you need to make enough money off those to cover your losing bets. So how do you do that? Well, the math is that if you have a venture capital portfolio, let's use easy numbers. Let's say you have 10 companies, you have 10 bets. Well, what's going to happen is that 8 or 9 of those companies are either going to fail outright, or they're going to bump along and never give you any real return. Maybe you'll get your money back or part of your money back, but you're not going to make any money on the 8 or 9 investments out of 10, right? 1 or 2 of them might be a success. So we're going to use in our hypothetical example that if you made 10 investments, 2 of them are a success and the other 8 are not. So it's a risky business. You made 10 bets, 2 of them paid off, right? That's the math on venture capital. So how do you quantify risk? knowing that? Well, let's think about it. Let's say you have a hypothetical venture capital fund and brand new, and in the bank you have $100 million. And you have promised your investors, a 20% compounded return on their money in 5 years. So a bunch of institutions, pension funds, those sorts of things, give you $100 million, and part of your LP formulation is that you'll give them back a 20% compounded return in 5 years. That is a realistic target. Every VC fund is going to be different. Some of them will have a higher return. Some of them will have a lower return, but not much lower, right? So that's the product, a 20% compounded return in 5 years. So this is the relevance of compounding to your thought process. So the math on that is 5 years from now, this venture capital fund with $100 million needs to pay back to its investors. And sorry, when I say its investors, the whole 20% doesn't go to the investors. Out of the 20% comes their cost of doing business, right? They have to have some real estate on Bay Street here, which is really expensive. They have a bunch of people. So they pay that out of the 20%. And then the balance goes to the investors, which would be, who knows, 12% or some lower number, but they need 20% return is the point. So out of $100 million, they have to generate $250 million in 5 years. That's the compounding. $250 million they have to have back in cash from the $100 million 5 years from now. If it's a 7-year fund, and the term of funds change, but 5, 7, 10 years are reasonable numbers to assume, they have to turn that $100 million into $360 million. Okay, so let's say your venture capital fund has 10 investments of $10 million each. That's equal math. So you spent your $100 million today, you have 10 investments, $10 million each. And we know that you need to have $250 million 5 years from now. And we know that only 2 out of those 10 investments are going to work. The other 8 are going to fail. So what does that mean? It means for each of the $10 million investments that succeed, you have to turn that 10 million into $125 million to get your 250 back from those 2 investments. $125 million from a $10 million investment in 5 years. That's 12.5 times your money in 5 years. That's a 65% annual compounded return over 5 years. If you have a 7-year fund, it's 18 times your money that you need to generate. That's a lot. Now, if you read around the internet, about what the VC business is, you're going to learn that VCs are targeting 10 to 30 times their money. In our example, we came up with 12.5, but they need that 10 to 30 to make their model work. Now, you know why. That's why they need that amount of money. And the next time you're told from a venture capitalist that they're not going to do your deal because they don't reasonably see how they can make 10 times their money off your deal, now you can stop being aggrieved by that. They need this to make that model work. All right. How does this impact your business model, your planning, and your valuation? Okay. Now you're a new business or you're a high growth business and you want some venture capital and you're planning for that. In your business, you need $10 million to make the business plan work. What does the VC need? The VC needs, in our example, they need $125 million 5 years from now, right? We've gone through all of that. So they'll they'll invest $10 million and you'll get and they need $125 million back in 5 years from you. Okay, so your plan, your entire business model, your entire strategy, your reality, which it then needs to be reflected in your deck and your business plan and your presentation materials, needs to drive home how you're going to pay them back $125 million in 5 years, right? And so how do you do that? You need to understand your exit, right? Who you're going to sell this business to, because you have to sell, right? You're not going to go borrow $125 million 5 years from now, more than likely. So you're going to go public. You're going to sell to a strategic. You're going to do something to raise a bunch of money sufficient to pay this fund back $125 million. And you need to understand the metric for the valuation. All right, we're back on. We had a YouTube crash. It's the second time again. Or maybe it's Ashley's computer that crashed. Recording okay, Ashley?
We are.
Perfect. So Fawad, our amazing producer, is going to take from YouTube the part of the show that we already did, and he is going to merge this with, we're recording this on the iPad right now, so you're going to see a little bit difference in the quality. And if Fawad keeps this clip, you'll know that, and if he doesn't, you'll just wonder why the quality changed. All right, so Fawad, keep some of this in because I have an explanatory note here. I'm going to pick this back up at a hypothetical new business or early stage business, and use what we now have learned and considered about venture capital product, how that impacts valuation. Okay, so you're a new business and you want to grow your emerging business and you need VC money. Hypothetically, let's say you need $10 million of venture capital money. What does the VC need? In our example, which we've already gone through, the venture capital needs $125 million back from you in 5 years. They gave you $10 million as an investment. Now they need $125 million back in 5 years. How is that going to happen? Your entire business strategy, your business plan, your deck needs to explain, and it needs to be real, how you're going to get back $125 million 5 years from now. And to do that, you need to understand who you're going to sell your business to in 5 years, or whether it's going to go public. And based on that strategic sale, or the public, or the IPO, or some multiple plausible ways to exit this business, excuse me, how do you get the $125 million? You need to know your valuation metrics, meaning what drives value, whether that be revenue, EBITDA, number of users, whatever the metric is, and you need to understand the multiple that's applied to that metric. So let's say, for example, your new business trades on revenue. You're a software company, or you're some other company that, revenue is a good rule of thumb for understanding value. And let's say in your business, you have a 2 times revenue multiple. So in 5 years, your business will be worth the revenue that you have, sustainable revenue that you have, times 2, okay? So what does that mean? If the venture capital needs $125 million, that means just to pay the venture capital, you need revenue 5 years from now of $62.5 million. Sorry, Ashley is playing other things during the show here. You need $62.5 million in revenue just to pay the VC back. It has nothing to do with you. You didn't get anything out of that deal, and obviously no venture capitalist is going to let you be diluted to zero in effect under that scenario. So obviously you need more revenue than that. But it's a big number. You need $62.5 million in revenue just to pay the VCs and for their $10 million investment, okay? Now, let's say hypothetically that you have a business plan and that you understand what the valuation needs. You've got all the background of what the VC needs and valuation. You have all the background on that. Now, and you have a plan that includes your metric being revenue and your multiple being 2 times. And let's assume that you have a reasonable argument that your new business is going to generate $125 million in revenue 5 years from now. So $125 million in revenue 5 years from now at a 2 times multiple. There's your metric, there's your multiple. That is a value in 5 years of $250 million, right? 125 million times 2, $250 million. And you need a $10 million investment from your VC. Here's an easy formula. The whole point of this whole discussion is to give you this easy formula. The formula is your post-money valuation. We did a Martinis with Scott quick shot on post-money and pre-money valuations. I won't go over it again here, but you can go subscribe to the channel and you can look up quick shots, which is a sort of a 3, 4, 5 minute technical topic. And we explain post-money, pre-money valuations. But your post-money valuation is equal to your exit value divided by your return on investment expressed as a multiple. Okay? Now, if you look up, I think this formula came out of Harvard way back when, and they used the term terminal value. rather than exit value. I've changed that. I think that terminal value is not specific in the sense that I think it derives from a discounted cash flow model where you have the terminal value at the end. So if you were a spreadsheeter doing that, you would use the term terminal value. But I think for ease of understanding for an entrepreneur, when they say that, what they really mean is exit, right? So you're going to sell or you're going to do an IPO. So the value you're going to get 5 years from now, your exit value, divided by your ROI, your return on investment required for the VC, expressed as a multiple. Let's apply that to our example. So your post-money valuation is equal to your exit value. Your exit value divided by the ROI. Your exit value is the revenue of 125 million, we said, times 2, which is your multiple. So your exit value is $250 million. What does the VC need? What's your ROI expressed as a multiple? 12.5. Why? Because they're giving you $10 million today, and they need $125 million out 5 years from now. That's a $12.5 million, a 12.5 multiple, right? So 250 million in exit value divided by 12.5 as a multiple ROI is a post-money valuation of $20 million. 250 divided by 12.5, $20 million post-money valuation. All right, if you had gone through the quick shot Martinis with Scott on post-money and pre-money valuation, you would already know this. But the second easy formula for you to understand is pre-money valuation is equal to post-money valuation minus the investment. So in our example, $20 million is the post-money valuation we just calculated in this easy formula, minus the investment, which is 10 million. The VCs give you 10 million, so 20 million minus 10 million is a $10 million pre-money valuation. What does that mean? Go through the quick shot, you'll figure it out. But in general terms, what it means is that your business today is going to be worth $10 million without any money in it. It's worth $20 million with a $10 million investment, okay? So your pre-money is $10 million. Think of the venture capital investment as a joint venture or a partnership. You're bringing to the table, as the business, a $10 million valuation without any money in it. The VC's bringing to the table $10 million in cash. You brought 10, they brought 10. What's the ownership? It's 50-50. You both contributed $10 million to a $20 million post-money venture. You're 50-50. That's the way they think about it. That's the way you need to think about it. And if you do, it'll help you build your business plan. It'll help you build your strategy. It'll help you in your negotiations with VCs. To which you are saying to yourself, wow, that's really interesting, but wait, I've entirely skipped dilution. And you're right. Dilution is a complicating factor in this and beyond the scope of today, but we will tackle that another day. And what is dilution? Think of it this way. You've said you need $10 million today. What if something goes wrong? What if you really needed $15 million? It's hard to plan 5 years from now what you're going to need and why. So if you're bringing it in, if you need an extra $5 million or $2 million along the way, you're going to get diluted, meaning you're going to issue more shares for that. And whose pocket do you think this is coming out of? Do you think it's coming out of the VC's pocket? Do you think they need less than their $125 million because your plan was wrong? Or do you think it's coming out of your pocket, right? I mean, that's a pretty easy question to answer. Obviously, this is on you. And to do that, you need to deal with this issue. And let's say the numbers are bigger. Let's say you need a whole bunch of money, 100 million or some crazy number, to make your plan work. But if you did that today, your pre-money valuation would be 0 or negative, right? That often happens, that it just drives day one the entrepreneur's percentage down to too low of a number. Well, what do you do about that? And the answer is you financial engineer. And that's where you come up with these ideas of, well, we're going to do a seed capital stage, then we're going to do a Series A, then we're going to do a Series B, and we're going to change the valuations of A and B and seed A and then seed, and then Series A, Series B. We're going to change the valuations along the way. And that's financial engineering. And the idea there is that you need a bunch more money, but you don't want to get it all at today's valuation. You want to build a bit more value first, lessen the risk. That's what brings the value in, and then raise more money along the way. So we'll tackle that in another show and maybe some strategies on how to do that. but you need to understand dilution. You need to understand financial engineering. And one of my philosophies in buying companies and doing deals like this, I always say, if you want to name the price, let me name the structure. There's a lot of value, excuse me, there's a lot of value in the structure, as much or more than there is value in the price of the business, in the value of the business. All right, so that's what that's our topic today on valuations and the venture capital business. Again, the idea is the better you understand that, the better you are at crafting your plan, doing your pitch to VCs, and in your negotiation. All right, let's get on to a different topic. That's a good martini. Let's talk about some cannabis craziness. Now, I wrote this show last week, and then we tried to record it, and the recording failed. We're having more problems today, but I think it's going to work out. So last week, we had two material events, one on CannTrust Holdings and one on Afria. I think there were other material events in the sector, but those two are relevant because we did shows on those two companies in August, and they were both about troubled companies and crisis management. The show on CannTrust, or the two shows we done on CannTrust, was about how to not deal with a crisis and turnaround management. The second show was on Afria, with examples of how to well handle a crisis and turnaround management. CannTrust Holdings was episodes 16 and 17 in August. You can go look them up on the Martinis with Scott channel. So the point of doing this little update segment today is, one, it's an update because we've done the show, but two is, a lot of people ask me, I get in conversations with clients and friends and everybody else about the state of the markets in Canada with respect to cannabis. And they all say that the euphoria is over, the markets are more sober, and there's no more bubble. And the point of today is I challenge that. I think the euphoria is not over, that we're living it as we speak, and that cannabis investors are still crazy, as crazy as they were a year or two ago. And I think the two material events at CannTrust and Afria highlight my point, which is why I want to do that today. Again, I've said this before, I personally, Martinis with Scott, Sinclair Range, nothing that I'm associated with is a securities dealer. We do not give securities advice. Don't take trading advice from me. I'm just giving you my thoughts in general on winning at business, the state of some industries, valuation, and things that I am an expert in. But we don't do any advice on securities trading. We're not qualified for that. I don't want to be in that business. Don't listen to me. Don't take this show and go trade on it. I've said that before, but I'll keep repeating it. You got that, Ashley?
Got it.
No trading.
No trading.
Okay. I will say that we did trade on CannTrust. We went short, and in 3 months we're up. We just exited. We were up 60%, more or less, in 3 months. 60% real, so annualized well over 200%. It just means I'm right. All right, CannTrust. So to refresh your memory, if you haven't listened to the show, this is a Canadian LP, means they're licensed to grow cannabis. And in 60 days, in the summer of 2019, July and August, they had a really bad period of time, and they lost $600 million of market value. In July alone, they had a whistleblower come through with a disclosure to the regulator, Health Canada, that said that CannTrust was growing illegal cannabis. In other words, they lied to the regulator. They covered it up by having false walls so the regulator wouldn't see it. And they grew some cannabis that they weren't licensed to grow. They got caught through a whistleblower. They put a voluntary hold on all future product sales, i.e. no revenue. They formed an independent committee of the board, which was not independent, but they formed a committee to investigate the legal grow. They were named in 3 class action suits. I believe that expanded to 5+. I don't know what the state of those suits are, but they're spending a lot of money in the US on class action suits. They terminated their CEO, they terminated their chairman. They brought an interim CEO who was not independent from the issue. they released news, or news broke in the business newspapers in Canada, that there was a bunch of, that this scheme, the illegal grow scheme, had been happening as early as October, November 2018, and that the insiders were, selling shares off. They were trading illegally, insider trading on this news. And again, I'm not here. The point of this show is not to be investment research or to make allegations against anybody. So I said in the original Martinis with Scott, 2 episodes on CanTrust, that I'm just giving you facts that we read from the allegations, news that we read from the newspapers, pick up from press releases, and we use those to try and hammer home a point. Same thing here. I'm not trying to suggest or allege that people are insider trading. I just know there's a police investigation about insider trading, or there was, I don't know the state of it, and those were the allegations by somebody else, okay? So again, that sort of ties into don't trade on this information. But, so they have this insider investigation going on. They announced the appointment of it, this is all in July of 2018. They announced the 19. They announced the appointment of an investment banker to explore strategic alternatives. Never heard from them again because there are no strategic alternatives. They announced they would not be filing the next quarter financial statement on time. In other words, they stopped financial reporting, and their auditor quit because the auditor didn't want to be associated. I think it was KPMG. I'm alumni from there. They did not want to be associated with this whole deal, properly so. They rescinded their prior audit, as far as I know. And they announced a securities and police investigation in July as well. So that was a bad month, right? And they lost $600 million in market value. They handled it terribly. You can go back and find out why on those Martinis with Scott episodes. And since that time, there's really been no news from the company of any substance. So in September, it feels like a year ago that this happened, but in late August, September, early October, no news at all from the company. And the stock slides from about $3 when we did the show in August to about $1.15, whatever, late September, early October. It just slid. There was no news. Management's not handling it well. The stock drops down. And so they got down to about $162 million market cap for a company that's arguably, I think today, is still worth zero. Or it's worth the cash in the bank, but we don't get to know what the cash in the bank is because they don't report. So we have no idea what that was, and I'm sure they're spending lots on legals. Anyways, October 14th, 10 days ago, I believe that is, there was an announcement, lo and behold, from CanTrust. And here's what the announcement said. It says that CanTrust announces that it's continuing to make significant progress on its commitment to take any and all actions required to both bring the company into full regulatory compliance and seek the full reinstatement of its licenses. Do you understand that to mean that they're going to get a license soon? I don't. It says that they're taking any and all action to try and get a license back. That's not a progress report. I hope they were doing that a year ago. I hope they're doing that all the time, taking any and all actions to get their license and to maintain their license. It's just such a misleading statement. And let's continue on. It said, what are the things that we need to do to get our license back? Well, it lists them out in 4 bullet points. Number 1 is stop growing illegal stuff and stop transporting illegal stuff. It says it in better words than that, but I mean, I think you get the point. It's not brain surgery. Point number 2 was get back the illegal stuff that you sold. So if you have stuff sitting in Alberta, in Ontario, you have cannabis sitting in Alberta, Ontario, in the retail stores that you grew illegally, get that back. Number 3 is improve the training of your people so you don't do this again. As if training was the problem. As if there was a training seminar that could have happened at 5 o'clock on a Thursday afternoon where management would have stood up and said, by the way, don't grow illegal pot, right? That wasn't really the issue, was it? And number 4 was improve your record keeping. As if record keeping was sloppy and that's why they didn't report to Health Canada that they were growing illegal pot, right? I mean, they built a false wall of plastic so that you couldn't see it. This was not a record keeping issue. Anyways, I'm going off base here. So there's 4 points that CanTrust needs to improve on to make this thing, to get their license back. And they're doing everything they can to improve on those 4 points. Now, I don't want to state the obvious, but to get a license to begin with, you have to have a plan. And part of that plan would be not to grow illegal stuff and to sell illegal stuff and to do record keeping. So it's not like you need to recreate the wheel, okay? Now, how did the market take this? Oh, actually, let me do one other point first. This was the real essence of the release. So they give you a bunch of crap up front. They tell you, we're taking all steps necessary, and here's the 4 points from Health Canada, which I think we all could have guessed what the 4 points from Health Canada were. And then it says, so to help us achieve these measures, we're destroying $77 million worth of pot, worth of cannabis. And there was a big article in the paper about how do you really do that? Do you burn it and let the smoke go over the GTA, or what do you do? But they're destroying $77 million worth of inventory to help them achieve these measures. Now, what does that mean? They don't tell you how much inventory they have because there's no auditor, there's no financial reports. They don't tell you that. So if you go back a few quarters to when they actually did report, lo and behold, their inventory was roughly $77 million. So, unless something material has changed, they're getting rid of all their inventory. They're taking a $77 million loss and getting rid of all of their inventory. That was the point of the release. Everything else here is fluff, okay? That's the point of the release, which is buried in this crap about Health Canada and how we're doing a great job to get things back on side. What else do we have here? That's not important. Okay, conclusion on the cannabis, the CanTrust issue. Destroying over $70 million, so $77 million worth of inventory. They still don't have a license. They never said there's a prospect of a license. We don't know if they're getting one at all. The auditor withdrew over fraud. That's not changed. They have multiple class action suits. They have police investigations, and they have no revenue. Yet, how did the market react to this release? They added $150 million of market capitalization based on this release. Okay, now this was last week's information. The stock stayed about the same. I took a quick look before we did this. As I said, I wrote this show last week. We tried to record it last week, so we're a little out of date, but in general, things haven't changed. They added $150 million of market cap. There was an intraday where they went up to over $2, I believe, from the $1.30-ish that they were at before, based on this release. So the point of this is, do you think Canadian cannabis investors are still acting rationally? Or are they still euphoric and looking for anything they can hang on to drive up valuations in this industry? This is still a bubble, and there's a good example of why. I can also just add on the CanTrust piece. We did a show on what not to do in a turnaround based on CanTrust. This adds more fodder for that fire, I think is the expression. Do you think this press release was honest? Do you think they could have just said, we got a bunch of trouble. We're writing off $70 million worth of inventory. That doesn't mean we're getting a license, but we're working on it. That would have been nice. Instead, from a persuasion perspective, they know that everybody is just looking for information on this company, and they're hoping that it comes back and is resurrected from the imminent death. And they use that to their advantage. I just find this a grossly misleading release. Not legally, but from a persuasion perspective. I think it just speaks to everything wrong at that company, in my personal opinion. The last point on this I want to make is, it came to light that the management team, the board of directors, all knew about this illegal grow in October, November 2018. And the last point of their release on October 14th, 2019 was that they're going to submit a plan to Health Canada to remediate, a detailed remediation plan to Health Canada on or before October 21, 2019. How long does it take to make a remediation plan? You got 4 points. 4 points is don't sell illegal stuff, train your people, have better record keeping. Like I said, to get your license to begin with, you had to have that plan. Why does it take a year to build a remediation plan? This is just crap. This company's going down. That's my prediction. Aphria released its Q1 results says in my notes here last week, so call it 2 weeks ago now. And at the same time, there was a research report that came out from 8 Capital. For you U.S. Guys that don't know, people that don't know 8 Capital, they're a very established investment bank in Toronto, investment dealer as well in Toronto, heavily into the cannabis business. They know the space, and they came out with a report, I think the next day or the same day, and the release from Aphria was fine. The earnings release was fine. The stock popped a little bit that day. It didn't have a huge impact, but it, in the words of 8 Capital, outperformed the sector that day based on the release. So the report that came out from 8 Capital lowered their target price from $11 Canadian to $9 Canadian, which was a bit of a shock to investors who would have been paying attention to that analyst report, because everybody thought the earnings were pretty good. Here's a quote from the research report, which I thought was brilliant and hammers home the point on the exuberance of cannabis investors. Continuing, it said, the reduction in our target price is based on projected 2020-2021 estimates. We believe that the stock's outperformance yesterday was driven by the market's interpretation that the company's reiteration of guidance is an overall positive. So the fact that they just said, we're still going to give you guidance, is such a positive in an environment where all the peers, the other cannabis companies, have withdrawn their financial outlooks, and they've expressed sluggish growth expectations until the introduction of derivative products, which means edibles. So what they said is, the market was so happy that, unlike every other company, Aphria didn't withdraw its prior guidance. They just left it. And that was such a happy thing for these investors that the stock outperformed on that. They went on to say that, by the way, for Aphria to meet its prior guidance, a couple things would have to happen. One is that they would have to have 60% plus sequential revenue growth over the next 3 quarters, which is something that has never happened in the entire history of Canadian cannabis. Never happened. Second, there are sell-through rates at the retail, and I'm gonna have to do a show on maybe a quick shot or a whole show on sell-through rates, because it's a really important concept that I find people don't understand very well. But their sell-through rates are unattainable. Why? Because there's not enough stores. There's not enough retail locations. It's provincially regulated. For you Americans, think state regulated. It's provincially regulated, and the build-out just isn't there. It says that there are current limitations and expected growth of Canadian brick and mortar infrastructure. In other words, there's no locations to sell this stuff, no matter how much you're growing. So, what's the conclusion? Sales are limited by distribution because there's not enough retail distribution in the provinces, and Aphria is not immune to that, right? That affects every LP. Although Aphria didn't question their guidance, which they should have, and every investor should know that, the market is so hungry for news and so hungry for positivity that they simply bought into the stock based on that. Again, I don't want to make it too big of a deal out of this. There was not a huge pop, and I think it died back down after that. But the point here is, the question and the discussion we often had is, what are the state of the markets? I think it's true that retail investors in particular, institutions, are not looking for new product very enthusiastically, certainly growers in the cannabis space, but don't think that we're out of the bubble, because when people are behaving this irrationally, we are not out of the bubble. So that is the show for today. And if I can get my phone open here, we will play the closing music. There we go. Thank you for listening. Sorry about the 2 different production issues. We had the crashing of YouTube, so I'm sure that Fawad will get that fixed. And what else do I have? You can reach me, you can reach Ashley. Go to sinclairrange.com, sinclairrange.com. That's our website. These posts go on the Sinclair Range site. Email us there. I'm sure there's a contact form. Put a comment on the YouTube channel if you want us to contact you. What else can I tell you? That's it. Subscribe on YouTube, Martinis with Scott. Subscribe on Apple Podcasts. Thank you so much for listening, and enjoy your week. We'll talk to you next week.